It is Wednesday, February 4, 2026. And I have to say, if you made the mistake of opening your portfolio app before, you've had at least 2 cups of coffee this morning, you are probably regretting it deeply. We are staring at a sea of red out there.
It is a brutal morning. There's absolutely no sugarcoating it.
No sugarcoating at all. I checked the crypto fear and greed index right before we started, which, is usually our emotional thermometer for the market.
Uh,
It's sitting at a chilling 14. Maybe 16,
oh,
yeah. That is firmly in extreme fear territory. I don't think we've seen readings this low, this consistently since the absolute depths of the last bear winter.
it sets a very specific, very heavy tone. Just to anchor us in the numbers before we get into the why and the what next, Bitcoin is currently fighting for its life, hovering in that $75,000 to $77,000 range.
Which is a huge drop from the highs we were celebrating not that long ago.
Oh, absolutely. And Ethereum has wicked down into the low 2000s. The general mood isn't just caution anymore. It's bordering on genuine panic.
Yeah, it feels heavy. It really feels like the air has just been sucked out of the room. So we have a very clear, very high stakes mission for this deep dive. We've taken a massive stack of sources today. We've got technicals from forex.com and CoinDCX. We have deep on-chain data from Glassnode, sentiment reports from Patent PC, and some heavy macro commentary on the whole Federal Reserve political landscape. We're going to distill all of this down to answer one single, very expensive question. Is this a falling knife that's going to cut your hand off if you try to catch it? Or is this a generational buying opportunity?
That is the trillion-dollar question. And to answer it, we really had to strip away the emotion of, looking at that red percentage on your screen and look strictly at the mechanics.
Yeah.
Because while the price action looks terrifying, the underlying data tells a story that is much more nuanced.
Okay, so let's start with the catalyst. Markets don't usually just fall off a cliff for no reason. Everyone, and I mean everyone in our sources, seems to be pointing the finger at one man, Kevin Warsh.
The Warsh effect. It is, without a doubt, the primary driver of this whole sell-off. President Trump has nominated Kevin Warsh as the next Fed chair, and the market is having a violent allergic reaction.
But help us understand the specific fear here. We knew a nomination was coming. Why does this specific guy scare the crypto market so much? Is it just that he's a new face?
It's not just the face, it's the entire philosophy. Warsh has a history, and in central bank terms, he is viewed as a hawk.
A hawk.
A hawk is someone who prioritizes fighting inflation and maintaining sound money over just stimulating growth or pumping the stock market.
Yeah.
Warsh has been very critical of quantitative easing QE in the past. He supports shrinking the Fed's balance sheet, which is currently sitting over $6 trillion.
Let's pause there and really unpack that for the listener, because shrinking the balance sheet sounds like boring accounting, but it's actually critical for crypto prices.
It is the single most critical thing for asset prices.
Yeah.
I mean, think of the Fed's balance sheet as the amount of liquidity cash they've injected into the financial system.
Right.
When they buy assets, they push cash out. That cash ends up in banks, in stocks, and yes, eventually it trickles down into crypto. It's the fuel. If Warsh comes in and says, we are going to sell these assets, he is effectively...
By sucking that cash out of the system.
Exactly. He's draining the pool.
He's pulling the plug.
And when you drain the liquidity pool, the assets that rely on easy money, so risk-on assets like Bitcoin, they're the first to suffer. That's what the market is pricing in right now, a future where dollars are scarce and expensive.
Okay, so the market is freaking out about a liquidity drought. But I was reading the commentary around the MEXC analysis in our stack, and they suggested it's not quite that black and white. There's this theory they call the Warsh-style combination punch. That sounds like a boxing move, but what does it mean for the economy?
This is where the nuance comes in and where the market might be overreacting a little. The theory is that Warsh might be a hawk on the balance sheet, meaning he wants to tighten the money supply, but he might also support cutting interest rates.
So make money harder to find by shrinking the supply, but cheaper to borrow by cutting rates. That seems contradictory.
It's a complex maneuver, almost a surgical one. The idea is to normalize the Fed's footprint, shrink that bloated balance sheet while keeping the economy moving by lowering the cost of borrowing. And if he cuts rates, that's usually bullish for assets eventually. But right now, the market isn't looking at eventually.
No, they're looking at right now.
They're looking at the immediate threat of a stronger dollar.
And the dollar has been ripping higher since the news dropped.
Exactly. When the dollar gets strong, assets priced in dollars, like Bitcoin, automatically look weaker. It's a seesaw. Dollar up, Bitcoin down.
And we are seeing the big players vote with their feet. The institutional exit has been just brutal. I was looking at the ETF data, $817 million in outflows in a single day.
That number is staggering. It's one of the worst days on record. And if you zoom out to year-to-date 2026, we're looking at over $1 billion in net outflows.
This kind of destroys the whole diamond hands narrative for the institutions, doesn't it? We spent all of 2024 and 2025 telling ourselves the institutions are here, BlackRock is here, they'll stabilize the price.
And that was always a bit of a myth we told ourselves to feel better. Institutional money is not loyal. It is not ideological. It's fickle. These are asset managers with quarterly targets and risk models. When the macro outlook shifts, like a new Fed chair threatening to tighten liquidity, they don't HODL through the winter. They rotate. They move out of risk assets and back into cash or bonds instantly.
They're protecting capital.
They're protecting capital, not believing in a monetary revolution.
So when the kitchen gets hot, the institutions are the first ones out the door. It's not just the Fed, though. The sources also mention some serious geopolitical tension contributing to this risk-off environment. Investing.com specifically mentioned U.S. interventions in Venezuela and rising tensions with Iran.
It creates a perfect storm. You have domestic monetary uncertainty with wars, and you have global geopolitical instability. When those two things combine, investors don't want digital gold. They want actual cash. They want U.S. treasuries. Currently, in this specific moment, safety is not crypto.
Okay, so that is the bearish case. The world is scary, the Fed is tightening, and Wall Street is dumping bags. If I stopped the deep dive here, I'd probably go sell everything and hide under my bed. But we need to look at the other side of the coin, because the data suggests that while the suits are panic selling, the crypto natives might be doing something else. Let's talk about that fear and greed index again. You mentioned we are at a 14.
Which is incredibly low. I mean, it's approaching historical extremes.
According to the analysis from Pat and PC, historically, when that index drops below 20, Bitcoin has often outperformed in the following 30 days. Are we looking at a classic contrarian signal here?
This is the textbook "be greedy when others are fearful" setup. The data supports this. I mean, if you look back at March 2020, the COVID crash, which felt like the end of the world, the index hit around 8 or 10. That marked the absolute bottom before a massive run. We aren't quite at 8 yet, but 14 is getting very close to that max pain threshold where sellers are just exhausted.
So essentially, everyone who is panic-prone has already sold.
Yeah.
There's nobody left to sell.
That's the theory. And if we look at the on-chain data from Glassnode, we actually see hard evidence of that. This is, I think, the most crucial insight in the stack today, so listen closely. Long-term holders, or LTHs, have actually slowed down their distribution.
Wait, hold on. Let's clarify that. The price is tanking. The ETFs are dumping $800 million a day, but the long-term holders aren't.
Correct. LTH distribution, which measures coins moving from old wallets, older than 155 days, to exchanges, has slowed significantly. They are taking some profits, sure, about 12,000 BTC per week, but compare that to the peaks of the bull market where they sell 100,000 BTC per week.
So this isn't a fire sale by the veterans. This is not the whales dumping.
No. This price drop is driven by panic from newer entrants and that institutional rotation we mentioned. The smart money, the people who have held through 2022, through FTX, through everything. They are mostly sitting on their hands. They are not scared of Kevin Warsh.
That is a massive distinction. The tourists are leaving, the locals are staying. And I noticed another detail in the Glassnode report about exchange flows. It mentioned a split between Coinbase and Binance behavior.
Yes, this is a very specific bullish signal if you know how to read it. Coinbase is often a proxy for U.S. institutional activity. So when we see selling pressure easing there, it aligns with the idea that the worst of the ETF outflow might be slowing down. Meanwhile, Binance, which represents more global, retail, or active trader volume, is actually transitioning to buy dominant.
So the U.S. institutions are done dumping, and the global retail market is starting to nibble at the dip?
It suggests the market is trying to find a floor. However, we aren't out of the woods. There is a technical trap we need to explain. The Glassnode report uses a term that sounds like something out of a physics textbook, short gamma. They say the market is in a short gamma environment. What does that actually mean for the listener's portfolio?
Yeah, please translate short gamma into English for us.
It sounds complex, but think of it like driving on an icy road. Short gamma essentially means that market makers, the big firms that provide liquidity to keep the market moving, are positioned in a way where they are forced to trade with the momentum, not against it.
So if the price drops, they have to sell more.
Exactly. If Bitcoin drops, their algorithms force them to sell futures to hedge their books, which pushes the price down even further. If it rises, they have to buy, pushing it up. They amplify the moves rather than dampening them.
It's an accelerant, it's fuel on the fire.
Right. The report suggests we are in a fragile stability. If we were trading higher, between, say, 94,000 and 104K, things would be stable.
Yeah.
But stuck down here in the 70,000s, volatility is being deferred. It's like a coiled spring. When the move happens, whether up or down, it's likely to be explosive because those market makers will be scrambling to cover their positions.
So buckle up. Volatility isn't over. Let's talk about specific assets, because even in this sea of red, there's some really interesting narratives playing out. It's not all just Bitcoin bleeding. Solana, SOL, is getting a lot of attention in these reports.
Solana is a fascinating spot. The MEXC analysis calls the current level, around the $100 psychological support, a Liberation Day support level.
Liberation Day, that sounds dramatic. What are they liberating?
It refers to liberating the value from the price action. Look at the fundamentals. Despite the price dropping to $100, Solana's network stats transactions per second, active wallets, stablecoin volume are actually stronger now than when the price was at 200.
Whoa.
The network is being used more, even if the token is worth less.
So the price has disconnected from the actual utility?
That is the argument. The sources label this a potential generational buy, targeting a bounce back to $150.
Yeah.
If you believe in the ecosystem, you're getting high-growth tech at a 50% discount just because of macro fear about the Fed. The network doesn't care about Kevin Warsh.
That's a great point. The code just keeps running. Then there's the outlier, XRP. In the middle of this bloodbath, XRP rallied something like 27% recently. How is that even possible when Bitcoin is fighting for its life?
XRP is bucking the trend completely. This seems to be driven by renewed risk appetite specific to that asset, likely due to ETF speculation. There is a strong belief among traders that an XRP ETF is inevitable, and they are front-running that news regardless of what the broader market does.
It just shows that crypto isn't one big correlated blob anymore. Specific narratives can still win even when the tide is going out.
Exactly. And another one mentioned is hyperliquid, HYPE. The sources call it a hedge.
I've seen this mentioned. Hyperliquid is that decentralized exchange on the Arbitrum network, right?
It is. And think about the business model. It thrives on volatility and trading volume.
Yeah.
So when the market is crashing and everyone is panic selling, volume goes up, fees go up, and the platform generates revenue.
So it's inversely correlated. When the market panics, hype actually does well fundamentally because the casino is busy.
Precisely. It's a way to get on chaos. If you think the market is going to be volatile, holding the asset that powers the trading venue is a logical move.
We have to circle back to the king, though, Bitcoin. We talked about the Warsh fear, but looking at the charts, the CoinDCX and Forex.com reports point out some structural weakness. Specifically, the MVRVZ score. Can we decode that?
The MVRVZ score is essentially a valuation metric. It compares the current market cap to the realized cap, the price people actually paid for their coins. It tells us if Bitcoin is overvalued or undervalued relative to its fair value.
And what is it telling us right now?
What's concerning is that this score is making lower highs. Even though the price was hitting highs recently, the MVRV wasn't reaching the same overheating levels. It indicates that investors are less convinced at these price levels than they were back in 2024 or 2025. It suggests exhaustion. The bulls are getting tired.
The momentum is fading? So where are the lines in the sand? If I'm staring at a chart, what numbers do I need to tattoo on my arm?
We need to watch the support levels closely. The immediate danger zone is $74,612.
That is a very specific number. Why that one?
It is precise for a reason. That level hasn't been broken definitively since April of 2025. It's a structural floor. If we lose that, the falling knife scenario becomes much more real. That opens the door to the 60,000s. On the upside, we desperately need to reclaim 80,000 to break this bearish bias.
There's also talk in the notes of a CME gap between 77.4 and 84,000. Traders love to talk about filling the gap. Is that real science or just financial astrology?
It's a bit of both, but it works because people believe it works. When the futures market closes for the weekend and the price moves, it leaves a gap on the chart. Historically, price tends to return to fill that gap. It acts as a magnet. So that gap overhead suggests we might get a bounce simply to fill it, even if the longer-term trend remains down. It gives us a short-term target.
Now, I want to zoom out, way out. We have this report from Trading Key that poses a massive existential question for the industry. It's not about this week or next week. It's about the very nature of crypto, they're asking. Is the 4-year cycle dead?
This is the paradigm shift. For over a decade, Bitcoin has operated on this clock. Halving happens, supply shock, number goes up, crash, repeat, every 4 years. Like clockwork.
But 2025 broke the rule. It was the first post-halving year in history to end in the red, down 6%. That has never happened before. Usually the post-halving year is the fireworks show.
That is a statistically significant break. And the expert analysis here suggests we have shifted from a halving-driven market to a liquidity-driven market.
So what does this all mean? The halving doesn't matter anymore. Satoshi's code is irrelevant.
It matters less. Think about it. In the early days, the miners selling their coins was the biggest selling pressure in the market. So when the halving cut their supply in half, it was a huge shock to the system. Now, the daily volume of Bitcoin is in the billions. The amount miners sell is a drop in the bucket compared to Wall Street ETFs, corporate treasuries, and the derivatives traders.
So Bitcoin has grown up. It's not a rebel teenager anymore living in the basement. It's a suit-wearing macro asset working on Wall Street.
Exactly. It's a mature macro asset now. It doesn't move just because miners get fewer coins. It moves because the global M2 money supply expands or contracts. It moves because of interest rates. It moves because of Kevin Warsh.
So we shouldn't be looking at a calendar counting days since the halving. We should be looking at the Fed's dot plot.
Precisely. If Warsh shrinks the balance sheet, Bitcoin drops. If he prints money, Bitcoin rises. It had become a liquidity gauge, just like the NASDAQ or the S&P 500, but with higher volatility.
That is a tough pill to swallow for the crypto purists who believe the math of the code dictates the price. But the data for 2025 is hard to argue with.
It forces a change in strategy. You can't just blindly buy the halving and wait 18 months anymore. You have to be a macroeconomist. You have to watch the liquidity flows. You have to watch the bond market.
So bringing it all home for our listener, it is February 2026. The sources call this a widowmaker month because of the volatility. What's the final verdict here? Are we buying or are we hiding?
It is a tug of war.
Yeah.
On one side, you have the macro. The Warsh nomination and the Fed fears are bearish in the short term. The dollar is strong and liquidity is threatened. That pushes prices down.
And on the other side?
On the other side, you have the technicals and on-chain data. The fear index at 14 says oversold. The Glassnode data says holders aren't selling. The MVRV score suggests we are nearing a value zone. These signal that a bounce is overdue.
So it's a game of chicken. Who blinks first? The panicked retail sellers or the patient long-term holders?
Right now, the long-term holders seem to be waiting for the panic to subside so they can scoop up cheap coins. But they aren't rushing. They are letting the market come to them. They know that extreme fear is usually the time to act, but they are waiting for that 74K support to hold.
Here's a provocative thought to leave you with, and this ties back to the cycle conversation. If Bitcoin is truly no longer driven by its own internal clock, the halving, but is now just a slave to global liquidity, does that mean crypto is no longer a rebel asset? Is it just another tech stock in a trench coat?
And to add to that, the core narrative of Bitcoin has always been digital gold, a hedge against the system, against money printing. But if Kevin Warsh actually succeeds in shrinking the Fed balance sheet and strengthening the dollar, effectively fixing the money printer problem, does the entire digital gold narrative crumble? If the dollar is sound, do we even need the hedge?
That is the trillion-dollar question. If the arsonist puts out the fire, do we still need the fire extinguisher? We will be watching the charts and, more importantly, the Fed to find out. Thanks for diving in with us.
Stay safe out there.